The UK has drifted away from being interested in the stock market, and it's easy to see why. The US stock market has performed very well in 2023. The S&P 500, which is the 500 biggest companies listed on stock exchanges in the US, returned about 24% and has continued on this run into 2024, so far up 6% since the start of the year. The UK markets, on the other hand, have not performed quite as well. In 2023, the FTSE 100, the 100 biggest companies listed on the London Stock Exchange, returned roughly 4%. The FTSE 250, which is the next 250 biggest companies, returned about the same, only 4%. So the US outperformed the UK in terms of stock market returns. But this is only 1 year. Over 5 years is astounding. The US was up 81%, and the UK still only up a measly 4.6%. Could this be the reason that investing in the stock market is far more popular in the US than it is in the UK? Well, in this video, I'm going to go through some of the reasons why investing in the UK is not as popular as it is in the US. As of 2024, roughly 23% of UK adults have invested money into the stock market, either through ETFs, other types of funds, or directly into stocks and shares. And comparing this to the US, they're about 61%, which is 160% higher than it is in the UK, which seems quite significant. Looking at age groups as well, Gen Z, which are people born after 1996, are more likely to invest in the stock market. I believe this is due to other reasons, like social media, investing becoming a lot easier in recent years, and the price of house ownership causing them to invest in other ways. Looking at this graph, which is the trend for US investing, we can see that US stock ownership has always been around 50 to 60%. And comparing this to the UK, which has always been around 8 to 10%. It's increased in popularity in recent years, but the UK is still far behind the US in terms of investing in the stock market. So what factors can we look at to determine why UK residents are less likely to invest in the stock market? I'm going to go through a few different aspects: market returns, popularity, and housing. Now, there are more factors than this, but these are the factors that I've chosen specifically for this video. Poor market returns are a big factor to consider. As stated earlier, the FTSE 100 only returned 4% in 2023, the same 4% return over the last 5 years, and even when we go back to the beginning of the millennium, in the year 2000, if you started investing then, you would have only returned 17%. This doesn't include dividends, but the performance of the market is what the public will be looking at. For many people looking at this, the returns will be shockingly bad when compared to the US. The S&P 500 has returned about 243% since the year 2000, and it's done incredibly well over the last few recent years. There are a few reasons why the UK may not have returned as much value, and the sector breakdown is one of them. The UK stock market is made up of mainly financials, consumer staples, and other cyclical and defensive sectors like industrials and energy. Comparing this to the US market, the biggest sector is information technology, and this makes up 26% of the market. So the big, high revenue growth tech companies are running most of the market returns in the US. And this could be one of the reasons why the UK doesn't really invest much. Their home market doesn't perform as well. This leads nicely into my next point. If investing in the UK stock market is not popular, and we saw that most of the UK adults do not invest in the stock market, then money is not flowing into the UK stock market as much as it is flowing into the US stock market, thus slowing down the price growth. This has a knock-on effect. If the stock market performance is bad, then people don't invest in the stock market. And if people don't invest in the stock market performance will continue to be bad. And over years of this happening, we can see that the UK stock market has suffered. If companies in the FTSE 100 and the FTSE 250 get more investment, then they can potentially use this money to grow. Thus, the UK markets may become a more popular place to invest. A good indicator of popularity is the forward PE ratio, which is the forward price to earnings ratio. The ratio is calculated by taking the share price and dividing it by the forecast earnings. This ratio is better to look at as it's forward-looking, whereas normal price to earnings is looking at previous data. So a simplification of this is if the forward PE is low, it means that the price is low, or the company is out of favor. And if the PE is high, then the price is high, or the company is favorable. So taking a look at the forward PE ratio of the FTSE 100 over time, we can see that we are currently at a low point compared to historical numbers, meaning that the UK market is out of favour and not a popular place to put your money. But it can also be considered cheap, whereas the S&P 500 is higher than its historical average and looks like it is rising. Therefore, we can say that it is more in favour and also more expensive. If we look at the current price to earnings ratio of the FTSE 100, it is at a 10.6, and the S&P 500 is at a 20.3. A significant difference in expectation and value. The S&P 500 is considered a more valuable place to put your money, and going in favour of this idea that the UK is not a very popular place to put your money, thus implying that investing in the UK is not as popular as it is in the US. The next point I want to highlight is that the UK population puts a high degree of emphasis on buying a home over investing in the stock market. This can be seen in the media and in the numbers. Around 50% of UK residents own a home. This is made up of 28% of those owning the home outright, and the remaining 22% having a mortgage. House ownership has increased over time, but we can see that there has been a plateau around the early 2000s and a drop-off in recent years. And if we look at the graph of house prices over time, we can see that the price of owning a home since the early 2000s has increased dramatically from around £150,000 to £285,000. The average gain of around 90%. So if you bought a home in 2005 and you sold that home in 2024, you would have on average made a gain of 90%. Many people have made hundreds of thousands or even millions from owning a home, and many use it as their retirement fund. Many young people have a goal of owning their own home, and this makes them less willing to invest in the stock market, thus making it a less attractive thing to do. If you invested in the UK stock market in the early 2000s, you would have returned far less of your money than if you just invested that money into buying a home. But house prices have gone up so much recently that it's become almost impossible for people to buy a home, or even consider saving a deposit for a home. And with investing in the stock market becoming easier and easier in recent years, it's easy to see why investing is becoming slightly more popular. I think there's a general disconnect between the UK population and the UK economy. What I mean is that most people don't care about the stock market, whereas in the US, it's almost become part of their daily lives. The UK government needs to take measures to get more investment into UK-based companies. This could help drive growth in the economy and, in turn, drive growth in the stock market. But it seems their focus is in other areas. Whenever interest rate decisions are made, the media seems to emphasise on homeowners or people trying to get onto the property ladder. There never seems to be a consideration for UK companies. If anything, it's more about how companies will up their prices, and the media then complains about it, instead of highlighting the fact that companies need to up their prices to support their investors. I've made a video recently where I explain the workplace pension. Now, you could say that this is how most people invest in the stock market, but most people don't even know that this is investing in the stock market. They are even disconnected from the money that they already indirectly invest in the stock market. I will still be investing in the US and the UK, as I think there are benefits to doing both. I'll be doing a video on why I invest in UK stocks in the near future, and you can follow my investment journey by subscribing to the channel. That is the end of the video. If you liked the video, give it a thumbs up. Any suggestions on improvements to the video content or ideas for content going forward, please leave a comment below and I'll give you a reply. And if you like this video, you can check out one of my other videos on screen now.